Welcome back, everyone, to the next module in our trading journey. Today, we'll be talking about a consistent methodology for approaching each and every trading setup. Whether you're a scalper, day trader, swing trader, or position trader, today's module will provide you a practical framework for trading. This premeditated analysis is a critical skill to learn and master if our goal is to become self-sufficient and profitable traders. With that said, let's dive right in as I introduce you to the LTE methodology. The LTE methodology is an approach I've designed over the course of my trading career. Put simply, LTE stands for level, trigger, and entry or exit, depending on where you are in the management of a trade. Let's break this down a little more to see exactly what we mean here. Let's start with level. A level is a clearly defined zone expected to act as either support or resistance. If you remember from Module 3 in our previous course, SR can be either diagonal or horizontal. It can also be a zone rather than a fixed price point. This is why mastering the basics is key as we move forward in this course. We want to become experts at identifying SR zones. By doing so, we will have a stronger grasp on areas we should watch carefully. Correctly identifying SR will help us mark out clear levels that we want to watch and observe. Now let's talk about the trigger in LTE. A trigger is an obvious reaction in price action at our predefined level. Now, what might a trigger look like? Well, first off, triggers tend to be price action based. That is, clear candlestick formations that immediately get our attention. These can be bullish or bearish engulfing candles, bullish dragonfly dojis, or bullish hammers, bearish gravestone dojis, or bearish shooting stars. Any of the above can constitute triggers. Don't worry if a lot of this sounds foreign to you at the moment, because once we dive into our examples, things will become a lot more clear. For now, we want to remember that triggers essentially add validity and confluence to our predefined levels. It tells us, hey, this level may be a good support or resistance to trade. We've observed a key reaction at this level, which leads us to believe it will hold for our trade thesis. With that said, I want to direct your attention to the E in LTE, entry and exit. This is essentially a predefined order type used to take a trade after a successful trigger has been observed. This is the execution aspect. Now, I want you to remember the following. Triggers can be entries or exits, but entries or exits cannot be triggers. We'll see exactly what I mean in just a bit, but for now, pause the video and repeat after me. Triggers can be the E cannot be the trigger. Great. Now that we have that out of the way, let's move on and take a look at an example. LTE can easily be likened to ready, set, go. First, let's talk about levels again. Here we have a daily Bitcoin chart. I've identified a potential SR zone that I believe will act as support if it gets retested again. We'll mark this out and label it as our level. We are now at the ready mark. We patiently wait to see if price will in fact come back down to retest this level. Now, let's fast forward a bit and talk about triggers. We see that price did in fact retest our level, and it would seem like the level is holding as support. Now, we dial it in and patiently wait for a trigger. This is the set and ready, set, go. In this case, the clear bullish engulfing candle is an obvious in-your-face trigger. It's a candlestick that shows clear dominance from the buyers. There is obvious demand at this level, and buyers are eager to bid it aggressively. We take the bullish engulfing candle as a successful trigger. Hey, this level looks like it's going to hold after all. Now that we have ready and set, it's time to switch gears and look for our go entry. Now, I'm going to show you two different ways of approaching the entry after we have identified the level and the trigger. The first is a higher low from our trigger. This higher low would essentially green light our setup, and now we can enter the trade with a market order or a limit order, depending on our preference and strategy. This is the go in Ready, Set, Go. We see our level has held, we see a successful trigger, and now we long a higher low after identifying our stop loss and our target. Don't worry too much about the stop loss or target, as we will cover that in more detail in the next section, during trade management. For now, it's key for us to understand the LTE process. So we see, based on this setup, that our entry would occur around 8,000, our target would be around 9,100, and our stop loss would be around 7,403. With that said, let's move on to another example of how we could have entered a similar trade using the same level and trigger. In this scenario, we'll notice that we waited for a higher high to form before actually entering the trade. We saw price trade and close above this minor resistance level here. So we set limit orders, expecting a potential SR flip in real time. We attempt to go long after we get more confirmation. Here, our entry would be around 8,100, our stop loss just below 7,500, and our same target of 9,100. Both of these examples should showcase exactly how we can use the LTE approach for any trading setup. That is, for scalps, day trades, or even swing trades. This approach provides us a framework for which we can approach each trade in a systematic and consistent manner. By doing so, we start building a routine, which ultimately helps us become profitable traders. Now let's move on and talk about trade management a bit. Trade management is a critical part of trading. It will likely have a dramatic impact on your bottom line P&L, depending on how involved or not involved you are in your trades. Now, most newer traders are usually better off being less involved to start. The reason being is that the more you try to tinker and tweak a trade, the less disciplined you will be. You will notice from your journal that you will usually cut winners too early and losers too late. The less involved you are, the more actionable data we will get out of our journal reviews. Now, let's discuss the fundamentals of trade management. First and foremost is bias. Bias is essentially our view on the direction of the trend. Are we bullish or bearish? Do we think price will go up or down? And for how long? These kinds of questions help us establish our bias. Our bias is essential for forming a trading thesis. And let's not forget that forming a trading thesis is at the forefront of any trading system. We form a thesis, we dial in a setup's parameters, that is, the entry, target, and stop loss, and then we let the trade play out. We quickly learn how strong or weak our analytics are when it comes to observing price action. We'll remember from the previous course that in order to be good traders, we need to be exceptional analysts first. Although being a great analyst does not equal a great trader, we need to add in strong risk management if our goal is to become successful traders. Anyways, let's get back to the topic at hand. Once we have established a bias, we will want to identify the FB, or first barrier as we like to call it. This is a key area where price may invalidate our trading thesis. This can be a minor support or resistance zone. Basically, the earliest indication that if price fails to break above or below this zone, our trade thesis may not be right. It's essential that we learn to identify correct first barriers as we begin to introduce more hands-on trade management down the line. Now, I'd like to talk about the most important part of our trade setup, invalidation. Invalidation is a predefined level that, when violated, should result in a change in our trading bias. Invalidation in a trading setup is essentially the stop loss. When our trade thesis is invalidated, we will want to exit a trade since our original idea is likely wrong. This is where a stop loss is placed. If we set a proper stop loss at or below our invalidation level, in a perfect market, touching this invalidation should lead to a trend reversal. Now, of course, markets are never perfect, and this isn't always the case. The important part to remember is that our invalidation is equal to our stop loss. When price touches our invalidation, we consider the trade a loss and we mark it in our journals for later review. Now let's flip back to our previous example and identify some of the fundamentals. Here we can add a first barrier. We identify this as a minor resistance level. If price is unable to breach the 8100 level, we can assume that a long trade thesis will likely be invalidated. If you'll remember in our second example, our entry actually came after we had closed above and retested this 8100 level. Pretty neat, huh? Now let's discuss invalidation. Since we identified the 7400 to 7600 level, we can highlight this most recent swing low at around 74.26. This price becomes our invalidation. We can assume that if price trades below 74.26, any long positions we are in are likely on the wrong side of the market, and we should exit them for a loss. It's essential that we stay disciplined when it comes to invalidation. Arbitrarily moving it will only lead to more bruises on both our ego and our portfolio if we keep moving this theoretical goalpost. Once we've identified these two components, it's up to the trader's discretion to decide how involved he or she should be. For the purpose of this module, I won't get into the various ways to manage one's trades. This is a very personal exercise and will vary from trader to trader. The key to remember is that experience will ultimately shape the way you manage your positions. In the next section, we'll be building on this concept and discuss the various ways to exit a trade. Thanks for watching, and I'll see you soon.